If we take a step back and look at what's been going on with the stock market over the long term, we see some interesting things. Ever since the 2008 market crash, we've seen one of the greatest bull runs in history. Stocks have gone up almost 500%, bringing the Russel 2000 above 2,000 points. A lot of those gains have occurred in just the previous year, where we saw it more than double from 1,000 points to what it is today. Now, this has left a lot of investors, including myself, wondering what is the best way to invest with stock prices being so high. As always, when it comes to investing, I like to go to Warren Buffett to see what he thinks and see what he is doing.
He says, if you deem stock prices to be overvalued or in a bubble, do you think it's best to keep your money in cash while waiting for prices to come down to a fair price? Or would it be a better idea to invest this money in some way while waiting until stock prices are fair again and then sell the investment to buy the stock?
Well, Charlie and I have had that discussion on a lot of things. We bought some stocks we really don't know that much about, but I'm not really comfortable doing that.
You're used to shooting fish in a barrel, but that's gotten harder.
We've got probably 10 to 15% of our total assets in cash beyond what I would like to have, just as a way of protecting the owners and the people that are our partners from ever having us ever get in a pickle. You know, we really run Berkshire to make sure that we don't want to lose other people's money who will stick with us for years. We can't help what somebody does that buys it today and sells it tomorrow. But we've got a real gene that pushes us in that direction. But we've got more than we've got probably 70 or 80 billion, something like that maybe, that we'd love to put to work. But that's 10% of our assets roughly, and we probably won't get a chance to do it under these conditions. But conditions change very, very, very rapidly sometimes in markets, and we do have people that would like to join us, but the market option they have is too great for them. And if they're publicly traded, I mean, they basically can't. They would have great difficulty, then making a deal with us, because somebody else would come along with using other people's money. It's, we may be unhappy about the 70 billion, but we're very happy about the other 700 billion. So it's not like we should complain.
So there is a clear strategy that Buffett employs. The main game of Warren Buffett is to find stocks that are undervalued. Ever since he picked up Benjamin Graham's book, The Intelligent Investor, when he was just 19 years old, he's invested that way. Find stocks that are cheaper than their intrinsic value. Now, let's be honest, in today's market, there's hardly any of those deals floating about. The S&P 500 is sitting at 46. That's 3 times higher than the average of 15 across history. And this is the second highest that they've been over the past 140 years. So Buffett's strategy in these times is very unique. He's got a huge cash pile of $138 billion. He could buy any stock, pretty much any business that he wants, but he's purposely choosing to wait, just letting that cash pile build up into something that even Jerome Powell would be impressed with. And essentially, he's waiting for a business to come along at an attractive price, preferably a big blue chip one, so that he can deploy most of his cash. But right now, these businesses don't seem to be showing up. They all seem to be going for sky-high prices. Buffett doesn't pay any attention to these. He only focuses on the parts of the market that are worthwhile.
Yeah, just raise your hand and the monitor will supply the microphone.
Thank you. Howard Winston from Cincinnati, Ohio. One question. Are you concerned about the rising valuations on the NASDAQ market, where companies trade at multiples of revenues instead of multiples of earnings?
The rising value of what did you say?
The NASDAQ market.
Oh.
Where they trade at 10 times revenues or more, 30 times revenues instead of 10 times earnings.
Yeah. Well, we don't pay much attention to that because throughout the careers Charlie and I have had in investing, there have always been hundreds of cases or thousands of cases of things that are ridiculously priced and phony stock promotions and the gullible being led into to believe in things that just can't come true. So that's always gone on and always will go on, and it doesn't make any difference to us. I mean, we are not trying to predict markets. We never will try and predict markets. We're trying to find wonderful businesses, and the fact that a part of the market is kind of screwy, that's unimportant to us. We tried a few times shorting some of those things in our innocence of youth, and it's very tough to make money shorting even the obvious frauds, and there are some obvious frauds. It really is. It's not so tough to find the obvious frauds, and it's not tough to be right over 10 years. But it's very tough to make money being short them. Although we tried a few times way back. We don't look at indicia from stocks in general or from PEs or price sales ratios or what other things are doing. We really just focus on businesses. We don't care if there's a stock market. I mean, would we want to own Coca-Cola, the 8% we own of Coca-Cola, the 11% of Gillette, if they said we're just going to delist the stock and we're never going, we'll open it again in 20 years. It's fine with us, and if it goes down on the news, we'll buy more of it. So we care about what the business does. Yeah.
I want to go back to 2008 to give you a look at how Buffett's strategy works. So, in 2006, 2007, the market was very pricey. Buffett was struggling to find deals, so he kept his money in short-term treasury bonds, which is considered the same as cash. In 2007, Buffett with Berkshire had $45 billion of cash on him ready to deploy. At that time, that was a lot of money for his investing business. Then, we all know the great financial crisis hit and stocks fell off a cliff. And Buffett, he started buying up stocks like mad. By 2009, that cash pile had reduced to $24 billion, almost half of what it had been in 2007. Buffett is probably one of the most patient investors that there is. If there's no bargains out there, he's prepared to let his cash pile build up until one comes along. Now, as he said in the interview, he used to try shorting stocks when they were clearly overvalued, but it didn't really work out. You just don't know how long stocks can run for, even if they are clearly overpriced. Just like people try to profit from shorting Tesla years ago because they thought it was well overvalued, it didn't work out, did it? The shorts failed. As Buffett said, it's tough to make money shorting stocks. What he does like to do when he feels that the market is overpriced is to look for those particular sectors that may offer some opportunity. As we see over the past year, Buffett did do some buying. He bought into some financial stocks like Aon and MMC, some telecom services like Verizon and T-Mobile, some consumer stocks like RH and Kroger, and also some medical ones like AbbVie, Maersk, and Bristol Myers Squibb. So there are sectors out there that still do offer some opportunity, but you have to be prepared for it. Just like Buffett is. Every day he's in his office, reading reports, scanning through different stocks, and looking for a deal. He has found a few, but not many, and what he's mostly doing is accumulating cash and waiting for an opportunity to come.